Most beginner ISA investors will begin building a portfolio by investing in collective funds. There are roughly 2,000 funds to choose from, sometimes grouped into geographical areas such as the UK, Europe, the US or the Far East, and further categorised by their investment strategy, such as growth or income. But finding the right ones doesn't have to be like finding a needle in a haystack. If you don't have a large sum to invest and don't have an aggressive attitude to risk, you might like a one-stop shop fund that provides an instant, balanced portfolio with investments in cash, bonds and equities. You can invest in the excitingly named mixed investment sectors, which aim to achieve diversification by giving you a maximum exposure to equities that they cannot exceed. This can range from up to 35% for low-risk investors, between 20 and 60% for medium risk, and up to 85% for high-risk investors. Alternatively, you can go for a global fund to spread your investments around the world. Or you can try a multi-manager fund, which will invest in other funds or managers, although these can have expensive charges. Funds that specialise in specific industries or emerging markets are much higher risk, so should only make up a tiny portion of your overall portfolio, if at all. The UK is the obvious entry point for most investors, especially as they will be far more familiar with the companies fund managers invest in. Over recent years, the UK's smaller company sector has produced some fantastic returns. But be warned, while the returns have been impressive, smaller companies are much higher risk than the big names of the FTSE 100. You'll need to research your investments carefully to check you're not investing in a dud. A good place to start would be the MoneyWise Fund Award winners, which you can find at moneywise.co.uk. But you can also research funds at a fund supermarket or platform website, where you can also go on to buy units in your chosen fund. When researching, look at the performance over the last 5 or 7 years and compare it with other funds in its peer group or sector. Also look at fund fact sheets, which will explain more about the aims and the goals of the fund. Buying direct from investment managers is the most expensive way of buying a fund, so most investors should consider a fund supermarket or platform when making their investment. They're cheap and convenient, and they make it easy to invest via an ISA wrapper, but they're not free. Platforms charge either a fixed fee or a percentage of the value of your investments. Generally, for smaller fund investors, platforms charging the lowest percentage-based fees work out the cheapest, while larger investors may do better with a platform that charges a flat fee. You should review your savings and investments whenever you receive a statement, usually at 6-month intervals. Compare the current performance of your fund with its sector average and benchmark index. This will tell you if the whole sector is depressed or it's just the fund that you're invested in. Also, be aware of manager moves. In an active fund where the manager is picking and choosing stocks, you really need to consider whether to take action if he or she moves on.